Welcome to another episode of the Einstein Retirement Daily, where we curate financial, economic, and market news and information that we think will be helpful to those of you who are gearing up for or already in retirement. In today's episode, what we're going to discuss is how the government, quote unquote, borrows money from the Social Security Trust Fund. So this is a common question that people have and concern that people have, and we're going to dissect that a little bit for you and try to increase some clarity of understanding. As always, if you hear something in today's podcast that causes you to want to take some action or make some changes in your specific situation, we insist, of course, that you confer with the appropriate tax, legal, or investment professional prior to making any changes. Hopefully, you're talking to somebody who knows your specific circumstance. Okay. As I mentioned, Social Security is something that technically is funded two ways. Number one, it's funded from inflows from your FICA taxes. So these are taxes that you pay on any earned income. Earned income, of course, being W-2, 1099, or self-employment income. Those dollars flow into the Social Security Trust Fund. And then what the Social Security Trust Fund does with those dollars is they either are paying them out immediately, which is happening today, right? Dollars are leaving the Social Security system that are flowing in now. And at the same time, if there's any excess funds, if there's any extra dollars, then the Social Security Trust Fund will purchase Treasury bonds from the U.S. Treasury Department. These Treasury bonds are what are known as special issue Treasury bonds. So there's two sides of this. Number one, if there's excess money flowing into Social Security, of course we want the Social Security Trust Fund to invest those dollars. That will help create robustness in the Social Security system and allow that system to last much longer than, say, if they just held it all in cash. Because obviously we know that holding dollars in cash is going to reduce over time the amount of dollars that are going to be available due to inflation, especially with all the inflation that we're seeing now and the money printing that has gone on. Inflation would eat away at cash positions. So we do want the Social Security Trust Fund to invest those dollars, but the question is how and where? Well, the solution by the Social Security Trust Fund is that they invest in a special issuance of U.S. Treasury bonds. U.S. Treasury bonds by themselves are marketable securities. They can be bought and sold on open exchanges, and you could buy them, banks buy them, insurance companies buy them, investment companies buy them, and they buy them to have a very safe return on their invested dollars. So when the Social Security Trust Fund purchased securities, these special issue securities, effectively what that did was it loaned money to the U.S. Treasury Department. So if the trust fund buys a U.S. Treasury bond, even a special issue, those dollars are effectively loaned to the U.S. government. It is true to say that the government does borrow from Social Security, but it doesn't borrow in the traditional sense, not how you would necessarily think. It's not as if, there's been the comics, I've seen political comics where artists have drawn out this whole idea that, there's a politician, that's like stealing money out of your pocket. And your pocket is the Social Security Trust Fund. You may have seen stuff like that. But and while that's a provocative way to describe it, it's not really accurate. Okay, the way that it actually works is that Social Security and its trust fund has the ability to buy U.S. Treasury bonds, and that effectively loans money to the government. In fact, at one time, Congress passed special legislation for the Social Security system back in 1982 to borrow money from the general fund of the U.S. government. So I remember that very popular Once Upon a Time Saturday Night Live skit with Mr. Al Gore saying, "We have a lockbox." For those of you who remember that, quite hilarious. But the whole lockbox idea, the reason why that never went through and never really became a thing is because it's kind of already a thing. Okay, from an accounting perspective, Social Security is its own entity. It has its own trust fund. Most of the dollars flowing in leave today, right now, to pay current recipients. Actually, all the dollars today. And actively right now, U.S. Treasury bonds, these special issue bonds, are being redeemed right now to pay current recipients. So again, we do have a problem with Social Security. It's very underfunded. And the only reason why there is not a funding gap right now is because those special issue Treasury bonds are being liquidated to fund current recipients. And we're good on that through the year. Now I forgot, 2036. So it's coming up quick. So there definitely needs to be some action taken to fix the system. But the government doesn't really steal money from Social Security. That's a misnomer. And they don't really have the ability to do it. It's not set up like that. However, we do loan money to our government through the purchase of these special U.S. Treasury bonds, but that's actually declining right now. Okay, it'd be great if we had more dollars flowing in to actually increase that, but not yet. Okay, that's not how it's set up. Okay, I hope this has been helpful to you. I know this is something that people often have questions about. Why should I count on Social Security? Aren't the government's just going to rob it and take it from us? Not really very likely. Okay, the Social Security Trust Fund is really in a stable condition at the moment. And there's not a big worry that they're going to steal money. If anything, they're going to do things to bolster it up. And eventually they'll have to. Many of you have a full retirement age. If you're a new retiree or gearing up for retirement, many of you have a full retirement age of 66 and some number of months. Some of you have a full retirement age of 67. The reason why that happened was because they had to fix Social Security. So your parents, grandparents at a full retirement age of 65, and then you got bumped up to 66, all the way up to 67. And so they will fix Social Security. It'll be some modification like that will affect your children and grandchildren. But that's how they borrow. Okay, they borrow money by buying Treasury bonds. It would be interesting to see what would happen if they would fund Social Security a little differently. They didn't buy U.S. Treasury bonds. They bought something different. Because right now, if we look at the average interest rate on investments held as of the end of September of this year, the yield is 2.368%. Yikes. Not a good interest rate, especially when you consider that things like the stock market has gone up substantially. There's, two sides of that coin, right? Investing in stocks has risk, but at the same time, 2.36% is really pretty terrible. And to give you sort of another benchmark on that, if we look at, say, the year 2000, September of the year 2000, the average interest rate back then was 6.688%. So we've lost 2/3 of our interest earnings on the Treasury bonds that the Social Security Trust Fund owns. That's your money, okay? And the fact that the Federal Reserve has opted to artificially lower interest rates is hurting today's retiree and the security of those Social Security dollars. So if you want to get upset about something with Social Security, maybe it's reasonable to get upset about the artificially low interest rates that are really hurting the stability of the Social Security Trust Fund. Okay, but don't worry about the politicians coming in and pickpocketing the Social Security Trust Fund. That is not how it works. It is always on a loan. Okay, I don't know if that should make you feel any better or not, but so far the U.S. government hasn't defaulted yet, so we'll go from there. All right, with that, I do enjoy doing these with you. I hope that you continue to get value from us here at Einstein Retirement Workshops. We'd invite you, if you haven't checked out one of our hour-long presentations, to do that. Subscribe to our YouTube channel. Follow us on Facebook. We'd love to interact with you at future events. And with that, we'll wrap up for today.